하나, 둘, 셋, 넷, 다섯, 여섯. 이거 다 된 것 같은데.
이제 잡으면 끕시다. Hello everyone. How are you?
Well,
Thank you.
doing well.
Thanks for joining our webinar, our first webinar here in Korea. We have
김희석 대표가 잠깐 화장실.
Hello.
We have 6 participants, as I announced. I'm moderating this webinar. My name is Sam Chung. I know everyone. So let me introduce one by one of our participants today. Mr. Jang Dong-hwan, who is the CIO of the Korea Public Officer Benefit Association. Hi, Mr. Chang.
Hi, thank you for having me here.
Okay, we have also Mr. Seo Jong-do Seo, who is the head of global investment and is at the Korea Investment Management.
Hi everyone.
Oh.
And we have Mr. Hee-seok Kim. He is a CEO of Hana Alternative Investment Asset Management. Hello,
Hi
Mr. Kim.
everyone. Hi everyone. Thank you for having me here. Thank you.
I know some of you already know each other, but there are a couple of persons who met for the first time at this webinar. So let me introduce Mr. Paul Lucek. He is a CEO and co-CIO of Ridgedale Advisors. Hi, Paul.
Hi, Sam. Thanks for having me here.
And then we have Mr. Brant Muller, who is very famous CEO and the founder of the Global Alternative Investment Forum, the AIF. Hi.
Hi, Sam. Thank you. Greetings all.
Thank you. And Sylvia Owen, Ms. Sylvia Owen, who is Managing Director of Axia. Hi, Sylvia.
Hello. Hi, everyone. Nice to see familiar faces.
Good, thank you. Let me start our discussion. We know it is very difficult time, the global pandemic period from the COVID-19. And in Korean market, everybody is very wondering about what is the current situation in global market of alternative investment space. And each of you has expertise in your area. So I would like to ask 3 of the offshore participants, Sylvia, Brant, and Paul, about your opinion and your view of current situation of the market focused on alternative investment. And especially, what is your view of what area or what sector do you think has the most impact from this environment, from this COVID-19? And how do you feel about that? Why don't we start from Paul? Can you introduce your firm and yourself, and could you answer my question about the current situation? What's going on?
Sure. Thanks, Sam. So my name is Paul Lucek. I'm the CIO and co-CIO of Ridgedale Advisors. Ridgedale Advisors is a firm that originally started out at State Street as Saris. And we bought ourselves back in 2016, and management took over the company. And we are an absolute return alternative global macro, systematic global macro program. The current situation that we have with COVID-19 is a tremendous high volatility, high uncertainty crisis event. It is not unlike the 2008 global financial crisis. However, the speed of which it's occurring has accelerated. I would approximate about 20 times faster than 2008 global financial crisis unfolded. And in these types of crisis events, as we've seen in the past, other types of crisis events like the 1998 Russian debt default, the 1987 the stock market crash, or the terrorist attacks in the US in 2001, 9/11. In each of these events, we notice a pattern reoccurring. The first stage is that volatility increases. Asset prices tend to go in a panic as buyers and sellers react instinctively to the market events. Fear takes over. The next stage is that assets that were not previously correlated before, strategies that were not previously correlated before, become correlated. So correlations get driven towards either +1 or -1. We saw that in the beginning stages of March when gold sold off, which is usually it's a safety move to buy gold in a panic event. But we saw bonds rally, we saw stocks fall, and we saw gold sell off, as well as oil and other commodities. So the correlations get driven towards positive or -1. And then the third effect that we see in these types of crisis events, and it's been consistent through 2008, all the way back to 1987 that I've been studying this, is that autocorrelation within markets increases. Markets tend to move around a fair value price, an intrinsic value that they exist around. And most investors trade on a fundamental or a what we call a convergent type of mentality, where they believe to buy the underpriced and sell the overpriced asset with the idea that it will converge to its intrinsic value, its fair value price. And that happens most of the time, 85% of the time, 90% of the time. Convergent strategies, convergent thought, convergent philosophies work because you're buying something that's naturally inexpensive, selling something that is expensive, and the prices converge to a fair value price, and you make a profitable trade on those moves. However, in these crisis events where fear and panic take over, markets move far away from fair value, or markets move towards a new fair value that is yet to be determined. The marketplace is not determined, and I believe for COVID, at least within the equity pricing, markets have not found what is the true fair value, what is the real extent of how long this crisis event will last. When can, for example, just speaking for the U.S., when can we get back to the office? When can the economy pick up again? So with a non-determinate intrinsic value for equities, we're in a period of uncertainty where divergent strategies, or strategies that follow momentum and trends within the market, tend to do extremely well. So that's what my firm has done over the years. First at State Street and now independently, we've combined convergent and divergent strategies to react to the market when it has these types of moves. So I think we're in a period of great uncertainty where fundamentals and value type of approaches will not work. Long only approaches will not work. Hedged absolute return strategies will probably do extremely well in this environment as they navigate through ups and downs of this crisis.
Okay. I think I understand. You said the convergent versus divergent strategy, and you are one of the divergent strategists.
Well, we combine both, but the divergent strategies take over the part of the portfolio and take much more of the risk in the portfolio when crisis events unfold.
Right. So in this time of period, the divergent strategy has a relative strength in their performance. If the underlying market has a huge volatility like this period.
Yes. Another way to think of convergent and divergent strategies are convergent strategies tend to be short volatility.
Right.
They tend to be mean reverting. Divergent strategies definitely correlate with being long volatility. So when volatility expands, they are the types of strategies that do well in this environment. So you'll see many trend following CTAs have positive performance in March. Whereas many long short equity managers or managers that have a long bias completely got crushed.
All right. Can I ask you what would be the last month, May, or up to today, like April, beginning of April, the performance of the divergent strategy versus convergent strategy as a market? So do you have any ideas, information about that?
Yeah, I mean, in our own product, the divergence was up around 25% in March, where convergence was down about 5%.
You mean the up 25% in the March?
That's correct. Yes.
That's your strategy.
Yes.
What about in the market?
So,
for example, global macro or CTA, how's
yes,
their performance?
it depends what indexes you look at. For example, the SocGen CTA trend following index was up, and they have two forms of this. They have one with actual managers, which was up about 1% or 2%. And they have a systematic index where they actually have trend following simple algorithms that they follow on a benchmark of markets. And that index was up about 18%. What we found is a lot of the CTA managers trailed the simple trend following index because they had too much exposure to equity. Equity has trended extremely nicely over the past year and a half, 2 years, even beyond. And many CTAs took exposure to being long equity markets. That was definitely a issue, in late February, March, as this crisis unfolded. Fortunately, our firm doesn't have that approach. We keep our equity trading except on the convergence side. So on the divergence side, we really took short positions in commodities, in equities, and in long positions in fixed income.
Okay, last question. My last question to Paul is, how do you think this kind of a trend will go? How long it will go?
Yeah, we foresee 3 possible scenarios. They're not of equal probability. The first is the V bottom, and the bottom that we've seen in March is the true bottom, and the market's going to recover from here. I think the only way that is possible is if there's a very quick move towards a vaccine that can immunize the global population. And as we all know, vaccines take much longer, even with the type of energy and effort that's being put towards finding and developing a vaccine or something that will block the virus. It's something that won't be available in 7 weeks, 10 weeks, 12 weeks. Another possible scenario is a U-shaped recovery where we go back and forth, ranging between levels where we are now, maybe a little bit higher, back down to the previous lows as news events come out in terms of, I think in the United States, we're going to see the infections move from New York more towards the west and more towards the south. That's going to affect other parts of our country. While maybe New York maintains a high level and hopefully, I'm hoping it tapers off. We don't have many new infections. And a U-shaped recovery could occur. We might hit the lows of March and perhaps go a little bit lower. I would say that scenario probably has a 30% likelihood, but I think the most likely scenario is that we actually head much lower from the previous lows of March. I don't think that the market has fully absorbed where the true intrinsic value is for equities. So our particular stance at Ridgedale is we're pretty bearish on the market, and we think that from the March lows, we could see another 30% lower, or 30 to 50% lower from the March lows.
I see. Interesting. I understand. Okay, next. Sylvia, it's your turn.
Great. Thank you.
What about your view?
Sure.
You please describe briefly about the Axia, what you are doing, and what is your role, and what is your opinion from your role about this market?
Sure. Yeah. Thank you, Professor Sam. So I think many of you, or a few of you, know Axia from our presentation that we did in last summer. Thank you very much again for hosting us so kindly. So Axia is a global consultant, a pan-alternative consultant. And since I met some of you over the summer, the big news for our firm is that we have acquired a competitor based in the US that does private equity and real assets. And so our offering is now truly across pan-alts, including private credit, real assets, private equity, and hedge funds. My role is I am Axia's global private credit strategist. I have also recently assumed the role of real assets global strategist. So in both of those alternative asset classes, I'm responsible for overseeing our global client base and implementing our portfolios. So obviously a very busy time right now. So I'm going to focus on credit for a moment because I think that is very topical, obviously. And I think a lot of what Paul says is quite similar to how we view the world. And a lot of people talk about these stages, right? So in our mind, in terms of the credit opportunity set, and I'm going to talk about liquid and illiquid credit, we really see it unfolding in three parts. The first is what we've already had, which is a dislocation in the secondary liquid credit market, where you see double B and investment grade bonds trading down, and perhaps a flight to safe assets that have traded down. So I think there is a view that is the first step. Is the near-term opportunity is trying to take advantage of liquid credit, and I think that the view is you don't need to go chase risky COVID bonds or loans that have traded down. There's plenty of things to do on sort of more stable, safer assets that have traded down, and a lot of those have actually already rebounded. The second stage, which is where I think it gets really interesting, is there will be a need for liquidity, so what we call rescue finance, and that will take place in more of the private equity drawdown structures. So as the economic impact becomes more defined, there'll be more opportunities. So these are companies that are probably not going to go into complete distress, but they need a liquidity bridge, and so they need a capital solution. So lending opportunistically into these capital structures, and having the capability to take over the company if needed will be an important skill set. But really, this phase isn't so much about deep distress. The final phase will be sort of what we call the outright distress, restructuring across different collateral types. So it won't just be corporate; it'll be obviously real estate, consumer collateral types. But in our mind, that's a really long opportunity set. So I agree with Paul that a lot of people try to draw parallels to 08, and there's actually, in my mind, very little parallel to 08. I mean, except for the fact that we've obviously had a big crisis and the market is down. But I think, the idea that we can just snap back and that you need to rush in and buy assets and have this V-shaped recovery, which was characteristic of 08, I think it's going to be more like a U. And some clients are saying like a U, like a really long U, or a W, meaning you go up, then you go down. And actually, someone pointed out something to me today, which I hadn't thought about, which is pretty obvious, that, look, all this stimulus is happening ahead of a, obviously, election year. So in November, we'll be either re-electing our current president or a new president. But anyways, after that, whoever is that president, there's only so much you can do. You can provide a quarter of stimulus, but can you provide stimulus forever? And I think, one manager that I was speaking to today is actually building a stress test of assuming that we don't go back until the end of summer. That's one possibility, which is starting to seem quite likely. Or we don't go back until the end of the year. And so with credit assets, duration is extremely important. A lot of these companies, if you look at them one by one, are going to run out of money. Either it's by October or it's by November, and they just simply can't survive. And so the duration is really important, and that is what we don't know. Nobody knows. So as Paul says, the equity markets haven't found their intrinsic value because you don't know what it is. It's an unknown factor. If we're not able to go back, or we have a huge spike in cases and deaths as soon as we try to go back, and because the other thing I think that hasn't been talked about that much, but it will become increasingly so, is that there will likely be, the longer this goes on, a permanent change in behavior, meaning that all bets are off. So if people are going to do this, right, Zoom conference instead of getting on a plane, I think that's definitely going to happen, at least on the margin. And the longer this goes on, the more likely that people will get more comfortable with this idea of remote communication. I mean, I think just 6 months ago, this idea would have been unheard of in some way. And the same thing with office space. If you think about on the real estate side, what will happen with office space? How will people work, a year from now? And then you just think about entertainment. So even if we did open the restaurants, how many people would actually go? They're talking about opening restaurants, but not the bars. And maybe you're in a restaurant, you wear a mask, and you have to have 6 feet apart. So all that is really sort of in people being fearful. So it's not just so easy as to flip a switch. So So the duration is really a big question. And then, just taking a step back, so private credit, has really grown up as a mature asset class. And so within our spectrum, we have 7 sectors. So we don't just have the corporate side. I sort of focus on the corporate side, but we also obviously have opportunities, what we call specialty finance. And I think the big difference this time around is that a lot of investors have set up their private credit buckets to not just be tactical, meaning that they're not just pursuing short-term or even longer-term distressed dislocation opportunities. They're really looking to build a strategic allocation, just like in private equity, diversified across different collateral types. And so we do think that there's opportunity, even in this environment, to think about where you can get attractive risk-adjusted returns on strategies that are not as dependent on forecasting the macroeconomic environment. So things like PE portfolio finance, legal assets, litigation finance, things like that.
I see. So briefly, you said there still have a huge opportunity on private equity, private credit markets, even though the market volatility is like this.
Yes, it will be. There's no reason to rush into distress right now. As Paul says, I think we're in the first of 8 innings, maybe 9 innings, who knows how many innings, but I think there's a very big danger of catching a falling knife right now because you just don't know. You can buy safe assets at discounts potentially, but even those may go down. And it's a question of what assets are actually truly safe if this goes on for many months.
Right. As Paul said, Sylvia, you also